we've noticed that there's at least a little bit of perhaps stability in the marketplace. We're 1% away from record highs, yet all of these risks still remain. Is this just the classic market cliche, markets love climbing walls of worry?
I think so, Dominic. When we look at it, some of the things that we find remarkable, if you consider, with a 5% hit essentially on global oil over the weekend, is that gold is actually just a little over $1,500 an ounce. So it's off its recent high of $1,550. You've got Bitcoin at $10,200 or so. When you look at the environment, as you just said, the S&P 500 near record highs, with technology up 30% on a year-to-date basis, real estate up almost 25%, communication services around 23%, and industrials up 22.7%. So the markets are telling us this is another pothole in the road, so to speak. I'd say a little bit more than a speed bump. It has risks. And I think it highlights the geopolitical risk and the vulnerability of infrastructure due to geopolitical tensions, which is significant. But so far, so good. It's well digested.
Can we talk about the quality of this rally towards record highs again? The only reason why I bring it up is because there is a view out there among some traders that this particular move higher may not be as popular, right? Because it's not the growth or those cyclical, economically sensitive stocks that are really driving a lot of the action, the traditional leadership in the marketplace, the FANG stocks, all of those. In this sector rotation that's been happening, is this a quality move higher if it's those value sectors and those value stocks that are driving the action upside right now?
I'd say it's more of a broadening of interest by investors to diversify within the market after a very strong performance of the technology, the FANG issues, and the growthier issues among the S&P 500. So we'd have to consider it really a positive move, but we don't think it's a major change in leadership. The reality is technology is ubiquitous, serves both consumers as well as businesses. And as a result of that, we're all in a constant upgrade cycle. So we look at it, we think this is a very natural move that the market has made and offers opportunity for some short-term traders to take some profits in the growthier stuff and move into more value-oriented areas and give a lift to the small caps, for example.
So where are you finding some of those values, in which sectors, which parts of the market, which industry groups? We've seen aerospace and defense at record highs right now. The housing sector continues to move and trend higher. Are there parts that are still values in this marketplace given the market move?
We'd have to think so, Dominic. Particularly, we'd see value in industrials and in financials. The financials have been well hated for practically years now, with expectations here that we've got a chance for some kind of a deal with China, if not in just the next few weeks or so, likely before the end of the year, we would think, or at least before February. We really have to think that where we are today makes a lot of sense the way the market is moving. And it's good to see that we've seen a bid for industrials and financials, which had been pretty much ignored. And industrials are the new technology. Industrial equipment is loaded with all kinds of sensors that make industrial equipment more efficient.
All right. So, John, before we let you go, does the U.S. economy need an aggressive campaign of interest rate cuts to sustain the economic expansion?
We do not believe so. Our thoughts would be 25 basis point cut tomorrow by the Fed would make all the sense in the world with conditions the way they are around the globe, the tensions that exist, and the trade war is still ongoing. But we think it doles out the cuts as needed, and all that will likely change with any kind of an agreement with China.